Movie theaters look busy on opening weekends. Lines fill the lobby, auditoriums sell out, box office numbers dominate headlines. Yet many theater chains struggle to stay profitable year after year. Some operate on thin margins, others carry heavy debt, a few collapse entirely. The issue is not a lack of interest in movies, it is the economic structure of the theater business, which turns cultural relevance into fragile financial performance. Movie theaters matter because they sit at the crossroads of entertainment, real estate, and consumer spending. They shape how films are released, marketed, and monetized. They employ hundreds of thousands of workers and anchor malls and downtown districts. When theaters struggle, studios adjust release strategies, retail traffic declines, and local economies feel the impact. Understanding why theaters struggle to stay profitable helps explain why the film industry has evolved the way it has. At its core, the movie theater business is built on fixed costs. A fixed cost is an expense that does not change much with attendance. Rent or long-term lease payments on large buildings must be paid whether seats are full or empty. Utilities run continuously to power lighting, climate control, and projection equipment. Staff are required to operate concessions, manage ticketing, clean auditoriums, and maintain security. These costs create a high baseline that must be covered before any profit appears. Revenue, by contrast, is uneven and difficult to predict. Attendance varies by time of day, day of week, and season. Summer weekends and holidays can be full. Weekday afternoons are often nearly empty. Demand also depends heavily on the release schedule, which theaters do not control. A strong slate of films can lift results. A weak slate can leave screens underused for long stretches. Ticket sales, which many assume are the main profit source, are not especially lucrative for theaters. A significant portion of each ticket goes back to film studios through revenue sharing agreements. These arrangements vary by film and by week, but studios typically take the largest share early in a release. This leaves theaters with limited ticket margins. To compensate, theaters rely heavily on concessions. Popcorn, soda, and candy carry high margins and are essential to covering fixed costs. That reliance introduces another vulnerability. Concession sales depend entirely on foot traffic. Empty seats mean unsold snacks. Pricing is constrained by consumer tolerance. Raise prices too aggressively, and customers buy less or skip concessions entirely. Theaters operate within a narrow band where volume must remain high to sustain margins. The physical design of theaters adds to the challenge. Auditoriums are highly specialized spaces. They cannot be easily repurposed when demand is low. A seat that goes unsold at a mid-afternoon showing cannot be recovered later. Economists refer to this as perishable capacity. Once a showtime passes, the opportunity to generate revenue disappears. Competition further limits profitability. Theaters compete not only with other theaters, but with alternatives at home. Home entertainment systems have improved significantly. Large televisions, high-quality sound, and streaming platforms offer convenience and comfort at a lower cost per viewing. These options eliminate travel, parking, and fixed schedules. As a result, theaters face constant pressure to justify their value. This pressure restricts pricing power. Ticket prices can rise gradually over time, but sharp increases risk driving customers away. Discounting during slow periods often fails to generate enough volume to offset lower prices. Theaters have little room to adjust pricing without consequences. These forces are visible in the experience of AMC Entertainment, one of the largest theater chains in the world. AMC operates thousands of screens across multiple countries. Its scale provides some advantages in purchasing and marketing. It also magnifies risk. The company carries substantial debt tied to leases and past acquisitions. Those obligations remain regardless of attendance levels. For years, AMC operated in a fragile balance. Strong blockbuster releases could lift quarterly performance. Concession sales could offset weak ticket margins, but the model allowed little margin for error. A few disappointing seasons could strain cash flow and increase financial stress. A major inflection point emerged as studios began rethinking release windows. Historically, films debuted exclusively in theaters for a fixed period before moving to home viewing. This exclusivity gave theaters temporary control over new releases. Over time, that window shortened. Studios sought faster access to digital revenue and more control over distribution. Periods of disruption accelerated this shift. Theater closures and capacity limits pushed studios to experiment with simultaneous or near simultaneous streaming releases. This weakened the theater's role as the primary gateway to new content. Even after reopening, consumer habits had changed. Some audiences returned, others did not. AMC responded with pricing programs, premium formats, and loyalty memberships. Larger screens, enhanced seating, and subscription-style plans aimed to stabilize revenue. These measures helped at the margins. They did not change the underlying structure. Fixed costs remained high. Demand remained volatile. The broader lesson extends beyond any single company. Movie theaters operate in an environment where costs are rigid and revenue is uncertain. Profitability depends on a steady flow of appealing content, cooperative studios, and consistent consumer behavior. When any of these factors weaken, margins erode quickly. This helps explain why consolidation is common in the industry. Larger chains can spread risk across more locations and negotiate better terms. But consolidation does not resolve the core problem. It often increases leverage, which makes downturns more dangerous. The economics of movie theaters reveal a gap between cultural importance and financial resilience. Movie-going remains a shared experience with social value. That value does not guarantee profitability. The industry survives by managing costs carefully and enduring long periods of thin margins. In the end, movie theaters struggle to stay profitable because they combine high fixed costs with limited pricing power and demand they cannot fully control. Each empty seat represents lost revenue that cannot be recovered. Each downturn tests the limits of the model. For audiences, the experience feels familiar and enduring. For operators, it is a constant exercise in efficiency, restraint, and survival.